I really don't understand how everybody's being so bearish on this. I think this is the most bullish meeting that he's had up until this point this year, and this is really just what we've been looking for. Alright, so as you all know, this week we had the Fed meeting, and they did raise those interest rates by 75 basis points, which was the expectation. We didn't really see a big volatile day, I don't think. I mean, I was saying that we wouldn't go any lower than the previous low of $17,000 from June, and we haven't done that yet. But of course, cryptocurrency is volatile as always, and yeah, we had about a $1,000 pump and then a $1,000 dump. But as long as we keep fluctuating between about $18,500 and $20,000, I would say we're pretty much moving sideways for cryptocurrency anyway. Last month we had a 75 basis point hike, and this month a lot of people were thinking that we might actually see a whole 100 basis point hike from the Fed, sending markets plummeting again and trying to take care of inflation. This is why we've been seeing a lot of uncertainty and a lot of downward momentum in the markets recently. But since the Fed is actually doing another 75 basis point hike, and it looks at this point like a 100 basis point hike is not going to be coming in the future, I think this is probably going to be taking a lot of the fear and uncertainty out of the markets. And while we might not be going up straight to a new bull market from here, I think we will probably be finding a floor, and I don't think we're going to be making a lower low, hopefully, from here. If we do though, however, we're probably going to get pretty dumpy, because after $17,000, I don't think there's very much support until about $13,500. So while it is always possible that we can make another leg lower, I do think that we are probably already seeing the floor, and I think that it is probably a good time to accumulate and get ready for the next bull market from here. However, though, like I said, this doesn't mean we're going to be going straight up from here, and we could definitely make another leg down, so definitely you probably want to keep a little bit of dry powder on the side just in case. Everybody's been talking about the Fed meeting and how they sounded really hawkish, and they said over and over again that they do have the resolve to bring down inflation to a sustainable level under about 2%, which is where their main target is for the long term. And of course the Fed is going to have to sound hawkish, because if they don't, then inflation could start to come back, as people do expect them to start being more accommodative. So in order to see what the Fed's real plan is, I think we just have to read between the lines a little bit, because as I said, they are going to have to sound hawkish, but they're dropping a few hints here and there that are alluding to the possibility that they could be cutting rate hikes here in the short-term future, and that they possibly might even be done or reaching the end of their rate hike cycle.
Today, the FOMC raised its policy interest rate by 0.75 of a percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%.
As I said, they are going to be trying to get inflation down to 2%, and that means that they are probably going to have to do some further rate hikes. But I do believe that they aren't probably going to be doing a whole 100% rate hike from here, and we might not even be seeing another 75 basis point hike moving forward. This would bring a lot of uncertainty out of the markets, and I think that this could possibly see us starting to recover, and at least at the very minimum, we probably wouldn't be seeing a lower low.
And in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time.
I don't think that the Fed is lying right there. I do believe that they intend on doing more rate hikes for the foreseeable future, really. But the real main uncertainty is that if they're going to continue raising rates at a higher percentage level every meeting going forward. In other words, are they going to be doing any more 75 basis point hikes, or are they going to even raise up to get a whole 100 basis point hike moving forward? Or on the other hand, are they going to do a 50 basis point hike moving forward from here, meaning that they think that they could be possibly reaching their target and that they might be able to start easing again?
What will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%.
Okay, he was pretty clear about what he's expecting to see before they can start to lay off of the interest rate hikes. And coming up here in just a moment, he's actually going to start explaining how these things are already starting to happen and how the Fed is starting to see some progress on their rate hikes and could start to slow down from here.
So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2%. before we would consider that. Part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation.
This means that he is starting to actually see signs that inflation could be coming down. That essentially means that he could start to take a little bit of a pause to see if the delay in the reaction of what he's doing is going to bring inflation down moving forward without him having to do increasingly higher rate hikes.
The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. You know, the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening, and of course the obvious example is housing, where you see declining activity and of all different kinds, and housing price increases moving down. So we're having an effect on interest-sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening.
So essentially, he just said that he's starting to see effects of his rate hikes taking effect on the economy, and not just our economy, but the global economy. These are the things that he just listed that he wants to see starting to happen so that he can lay off the gas pedal when it comes to these interest rate hikes moving forward. This is really a bullish signal for the markets, but of course you have to pick through all of the hawkish statements that he's made, because he is trying to keep people's expectations high for the interest rates going forward so that inflation doesn't come roaring back.
As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year.
If they expect us to have 0.2% growth this year, and we've already had 2 negative quarters of GDP, then what does that mean going forward? Doesn't that mean that we're not going to have any positive quarters of GDP this year? And if there are 4 negative or flat quarters of GDP in a row, doesn't that mean that we're not just in a recession, but we are actually in a depression? If the Fed does think that we're going into a depression, then that could explain why they haven't said we're in a recession up until this point, because they're trying to save that terminology for whenever we actually see a depression, and then they don't have to call it a depression whenever we actually get there.
The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year.
That's really important because, as you might already know, obviously, their first mandate is to keep inflation under 5%, but their other mandate is to keep unemployment under 4%. And if they're expecting unemployment to go up above 4%, then that means that obviously they're seeing some real signs that what they're trying to get accomplished is actually going to happen, and this means that they can probably start to slow down their interest rate hikes.
A half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level.
He just said that over the next few years that it actually runs higher than that, and that means that they are going to have to do something like possibly even lowering interest rates to stimulate the economy and bring that unemployment rate back down whenever we get to that point.
At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy.
So essentially, we are going to continue raising interest rates because inflation is still high, but
Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation.
There it was. He basically just said that they are starting to consider the possibility that they will need to slow down their interest rate hikes moving forward from here. That is really bullish for the markets, and that could mean that we have seen inflation peaking and that the Federal Reserve isn't going to be doing any more 75 basis point hikes or any higher than that.
We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy.
He just said that they're not going to reduce the policy. That entails that they're not going to be lowering interest rates prematurely. That doesn't mean that they're not going to continue to raise rates or that they are going to continue raising rates. That just means that they're not going to be pivoting, and pivoting means that they're not going to be lowering interest rates.
As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year. Of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation.
He basically just doubled down and said it again, and in my opinion, he couldn't really be any more clear that he is starting to see the effects of what he's doing taking place, and that they are probably going to have to slow down these interest rate hikes so that they can see the lagging effects of this policy moving forward, because it does take several months for the interest rate hikes to actually have a full effect on the economy.
And I think we'll just have to see how that goes. There is a possibility certainly that we would go to a certain level that we're confident in and stay there for a time.
He actually just mentioned a pause. If they stay at a certain level for a time, then that is a pause, and that means that not only are they considering slowing down the rate of their interest rate hikes, they could actually pause the interest rate hikes and not do any hikes for a couple months moving forward as they wait for the economic data to catch up.
We believe that we need to raise our policy stance overall to a level that is restrictive, and by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. We've just moved, I think, probably into the very lowest level of what might be restrictive, and certainly in my view and in the view of the committee, there's a ways to go.
As I said, if you do read between the lines, this is actually a really bullish speech in my opinion, because he did just say that he thinks that they finally just got interest rates up to a reasonably restrictive level so that they can start to see the effects happening that they want to see.
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I mean, I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Right there, he just said that they do foresee inflation coming down to 2%. And in the beginning, he said that that was what they were looking for to see if they were at the height of what they have to raise interest rates to. If they do see strong indications that inflation is coming down to 2%, then they can start to re-examine their interest rate hikes and possibly even slow them down. In the beginning of the video, he said everything that he wanted to see, and then throughout the rest of the video, he basically said that he's seeing all of those things starting to happen. And then he said 2 times that they could slow down interest rate hikes, and 1 time he even said that they might pause. I don't know how this could really get any more bullish unless he just straight up came out and said that in the next interest rate hike, we're not going to be doing 75 basis points, and we're probably going to be slowing things down from here.
You know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition.
That was very important because we have 3 months left in this year. If they're going to do 3 more interest rate hikes by the end of the year and they do 125 basis points by the end of the year, then you can imagine that they're either going to have to do, if they do 75 basis point hikes in the next meeting, then that means they could only do 25 in the next 2 meetings, or a 50 and then 0. So if we get a 75 basis point hike in the next meeting, I think it is going to be dropping off really fast after that. But I really don't see that as a really strong possibility, because he also said that there are some Fed members that think that they could only do 100 basis points by the end of the year. And even if they did 125 basis points, that would probably look more like 250 basis point hikes and then a 25. And if they do 100 basis points of hikes by the end of the year, then that'll probably look like just either a 50 and 2 25s or 2 50s and a 0, I guess. In other words, what he basically just said is that they are starting to see all the effects that they want to see from their interest rate hikes happening already, and that they're probably not going to be doing any more 75 basis point hikes moving forward from here, and they might even be pausing by the end of the year. And once again, guys, I really don't understand how everybody's being so bearish on this. I think this is the most bullish meeting that he's had up until this point this year, and this is really just what we've been looking for, because as I said, he can't just switch and start being super dovish, because that will bring back inflation really quickly. He has to keep people's expectations high that he is going to do what it takes to bring down inflation. But at the same time, he is giving out really strong hints that he is getting to the point that he needs to be at, and that he can start to cool off the interest rate hikes, hopefully moving forward from this point on. Additionally, we just got news that a Bitcoin whale moved 3,284 Bitcoin off of Coinbase and onto a cold storage wallet, and that usually means that they're not going to be selling that Bitcoin anytime soon, and they probably think that the bottom is in. The total crypto market cap has shown relative strength even after the merge and the Federal Reserve rate hike, and that's really bullish, especially since, as you can see, the S&P 500 did take a pretty significant dip, and Bitcoin stayed relatively strong and had even a little bit of a recovery since that Fed meeting the other day. The good news just keeps pouring in, because NASDAQ joined BlackRock as TradFi defies the bear market and embraces crypto. And this is, as I keep saying over and over, really what you want to be paying attention to, because these are the big dogs, the big players in the game, and the whales, and you want to swim with the whales, because this is the smart money, and you want to be doing what the smart money is doing. While all the dumb money is panicking and saying that we're going to be going down, all of these really big institutional players and all of the smartest money in the world really is buying into cryptocurrency, and that is probably a sign that we're not going to be going too much further down, and that this really does have huge upside potential. Here's a list of some of the biggest companies in the world that are invested in blockchain companies, including Alphabet, which is Google and YouTube, which you're using right now. They're invested in Fireblocks, Dapper Labs, Voltage, and Digital Currency Group, with $1.5 billion as of June, and BlackRock is the second most invested, with $1.170 billion invested in Circle, FTX, and Anchorage Digital. Morgan Stanley, Samsung, Goldman Sachs, PayPal, Microsoft, all the people that really run the world, all of these banks are all invested into cryptocurrency. And if they are, then I am too, because like I said, these are the smart money, and they obviously see potential in this technology, and I'm not going to miss the ride. Going into the charts, you can see that Bitcoin does have a bullish divergence here on the RSI for the 4-hourly chart, and with the 4-hourly chart being really oversold, or down towards the oversold on the RSI, and the daily chart bouncing off of the oversold territory here, I think that, like I said, as long as we don't make a lower low here, then this is probably going to be a pretty solid floor. And if Bitcoin can actually break above this downward trend from this white line right here that we've been under since really the top of the market, then I think this is going to be the real strong signal that we've been looking for. And I'm going to be pouring as much money as I can into these markets, because the top of this wedge is the price target for this signal, and that is, like I said, the top of the market again. This won't mean that we're going to be going straight up to the top of the wedge to a new all-time high, but I do believe that if we break out and have a solid confirmation outside of this downward wedge, then we probably aren't going to be making any lower lows. Unfortunately, however, if we do make a lower low below about $17,000, then we could be revisiting the bottom of this wedge, and that could bring us down to about $12,000. Ethereum is currently sitting here at a level of support at about $1,300, and if it can find support and go up from here, breaking out of this downward wedge, then basically it's the same thing as for Bitcoin, and I think that the price target is eventually going to be the top of the wedge again. But if we do break down below this, then we could be coming back down to retest this downtrend, this downward trending support line that we've been interacting with since the top of the market as well. Or at the very least, we could be coming back down to the bottom of this wedge that we broke out of to the downside a couple of weeks ago, with the price target for that being about $1,000. If we find support at $1,000, then that could make a solid double bottom here with a possible bullish divergence here on the RSI, which would be a strong indication that we'll probably be making at least a significant relief rally to the upside from there. Speaking of double bottoms, if the S&P 500 does find support right here and makes a bottom bouncing to the upside, then that will be a solid double bottom, and probably it'll be going back to the upside a little bit more from there. And there does look to be a possible bullish divergence here forming as well. If the S&P 500 bounces here and goes to the upside, then I think we're going to be seeing some significant strength in cryptocurrency, especially since crypto didn't see this dip that the S&P 500 did after the Fed meeting. Finally, let's move on to the dollar. Over here we have the dollar moving a little bit higher, but it is seeing a bearish divergence on the RSI, which could be seeing it have a rejection and making a lower low here, hopefully. If the DXY does go lower, then that is probably going to be seeing the S&P 500 confirming that double bottom, and the same thing for Ethereum, and then all of cryptocurrency and hopefully the stock market will be seeing a little bit of a relief rally. This is also confirmed by this bullish divergence here on the RSI for the Euro-US dollar pair, and that's basically the opposite of the DXY. So if the Euro dollar pair goes up, then that will bring the DXY down and send assets to the upside. In my opinion, all of this is super bullish, and I think that basically everybody being bearish is probably a good sign that we are at the bottom, because I like to take a contrarian view, and as they say, whenever people are fearful, you want to be greedy, and when people are greedy, you want to be fearful. People are super fearful right now, even in the face of all of this bullish news, and I think that this probably is the best sign that we're going to be seeing the bottom that you could ask for. But like I did say, there is always a possibility that we could make a lower low here. And if Bitcoin does break down below about $17,500, then it could definitely be coming back down to retest this downward trending support line at the bottom of this wedge around about $12,000 to $10,000. Just because it is possible doesn't mean that it's going to happen, though, and I definitely don't think it's going to happen, because we have seen a really significant downward pressure up until this point, and if we go down that much further, then that's going to be about another 50% drop, which I think would actually take a really strong catalyst to move us down that significantly from here, because really, we've already seen all of the bearish news that they could throw at us, in my opinion, and unless some unforeseen catastrophe happens, I really think that we've probably seen all of the uncertainty and fear that we could possibly see in this bear market. Let me know what you guys think. With everybody being bearish, it really does seem strange to me to actually be sounding this bullish, because of course I'm just going against the grain. But like I said, I'm trying to be greedy whenever people are fearful. So Thank you guys so much for watching. I hope you have a wonderful day. Don't forget to hit that like button. And if you want more real-time updates and don't want to wait on a video, then go ahead and join my Discord. There's going to be a link down in the description. I post updates over there every single day whenever there's any kind of events like a Fed meeting or an interest rate hike. I hope you have a wonderful day, and I'll see you next time. Bye.